Hello, welcome to my War and Markets next episode. I'm recording this in the morning of 30th because I was waiting for the Fed policy. I hope you managed to see the short video that I put up on the Fed policy itself. So the market yesterday was a very unique market in the sense that it saw a good rally in the middle of the day and then fell off by the last, losing almost 150 points. And the advanced decline ratio was also almost 50-50. So clearly there was the events yesterday which were that one was, I think, the geopolitics was not favorable, so the oil was high. But UAE's decision to exit the OPEC, well, initially it was received well. Later, we saw the oil prices actually firm up to about $116. It's a very unexpected thing, but that's because I think the Hormuz Strait closure is what decides the immediate future of oil. The medium-term supply from the UAE would probably ease the oil. But today, because of the fracture within the OPEC, I think the market was a bit nervous. The crude market was a bit nervous and took up. But as I see it now, this morning, the crude has again eased back to about 111. So I think the UAE has been absorbed now, and now it's the geopolitics which will be in the forefront. So this sell-off then was because of this nervousness and Trump rejecting Iran's latest proposals and say that he will continue the economic blockade till Iran yields to its terms. So clearly, that doesn't look like the deal going to be happening very soon, and that's where the market was reflecting a bit of safety yesterday because what happened was that the rupee weakened to 94.85. Now, for looking at the hints for today, if you look at the GIFT Nifty, it's flattish, but slightly in the red. The US markets are also the same, flattish and slightly in the red. That's mainly because the Fed policy was a hawkish hold, as I've covered in detail. But the fractured Fed meeting, where actually only one person wanted a rate cut to be considered, all the others were a bit on the hawkish side, plus the fact that this is the last Powell meeting, meant that US now seems like there's going to be no rate cuts for the rest of 2026 if this situation persists. So from that point of view, I think the US interest rates have spiked up to 4.41. The dollar index marginally went up to 99 from 98. So for the Indian markets, then this means that there is no tailwind for FIs to put into emerging markets because the US yields are even higher. So there will be a kind of, so yesterday if you saw, in fact, FIs and DIs were fairly matched. FIs selling about 2,000 odd crores, DIs buying about 2,000 odd crores, probably because they were waiting for the Fed policy before making any commitment. But that's not helped today with the hawkish hold. FII will continue in the same stance, I feel. And because yesterday was also the start of the new F&O series, there was a bit of rolling over of the shorts and that kind of an action. So today, yesterday's best performers like auto, realty might be under pressure, plus banks, because the rate situation is not now favorable. So there could be some pressure today, and it is a bit worrisome that the oil price not coming down is not being factored with the market, and the market is actually holding up. So this is probably because of the retail and the DII buying a little bit, but I think we need to be cautious in terms of tracking the trend of oil and the impact on the earnings. Earnings, as usual, the companies which are reporting good earnings are leading to a tailwind on the particular sector itself. So the market will continue to be today also in a nervous, flattish, consolidating zone. And as an investor, a medium-term investor, the strategy doesn't need to change. Stay in the accumulating, diversified, staggered zone, right? Do hear this in context with the Fed policy update that I had done a bit more in detail. Thank you and look forward.